How do banks detect credit card fraud? Have you ever wondered how banks keep your money safe from fraudsters? It all comes down to a mix of technology, data analysis, and smart monitoring. Let's break it down. Banks primarily look for unusual transaction patterns that stand out from your normal spending habits. At the heart of this process are real-time machine learning models and algorithms. These systems analyze your transaction data as it happens. They are trained to spot anomalies like sudden large purchases, especially if they occur in foreign locations. If you usually buy coffee every morning but suddenly make a big purchase in another country, that raises a red flag. Banks compare your current transactions against your historical spending behavior, location, and types of purchases. If something seems off, the system might automatically halt the transaction or flag it for further verification. This often leads to the bank reaching out to you for confirmation. In addition to machine learning, banks also use rule-based systems. These systems apply specific criteria to identify potential fraud. For instance, if a transaction exceeds a certain spending limit, it gets flagged. More complex rules might look at correlations between various data points, such as how often you shop at certain stores or where you typically make purchases. Behavioral analytics is another key player in fraud detection. This involves ongoing monitoring of your activities to catch any changes in your spending habits. For example, if your card is suddenly used in a different country or for an unusually high amount, that's flagged as an unusual transaction pattern. To further enhance security, banks use multi-factor authentication methods. This includes biometric verification and three-dimensional secure protocols, which requiring extra confirmation from you before a transaction is approved. Tokenization is also used to protect your card data during transactions, adding another layer of security. Machine learning models like AdaBoost, logistic regression, neural networks, and decision trees are effective in detecting fraudulent transactions. These models learn from large datasets of both legitimate and fraudulent transactions. As they process more data, they become better at spotting even the smallest signs of fraud. Overall, banks take a layered approach to detect and prevent credit card fraud. By combining real-time data analysis, behavioral monitoring, rule-based checks, and advanced authentication methods, they can quickly identify unusual transaction patterns. This helps protect both you and the financial institution from fraudulent activities.